What's up, traders? Matt from the Trade Brigade here doing your broad market analysis. We'll, of course, cover SPY, the Qs, and IWM. On the left-hand side, we have the daily time frame, and on the right-hand side, the 30-minute intraday time frame. First things first, what do we have going on in the S&P 500? You can clearly see our candle structure on the day is bearish. A little bit of an upper wick there, red, weak close down towards the lows. It's bearish, right? From a structural perspective, we have a bearish inverted hammer with, again, a weak close. Now, from a location standpoint, we obviously have a lower high on the day, a lower low on the day. However, here's a little bit more of a nuanced perspective, right? We did try to come into this low, but we did not make an equal or lower low. Now, I'm not saying that to sort of imply that this has to hold for some sort of nuanced higher low, and it means we're going to get something like that. That's not what I'm saying. But what I am saying is that we're right at that level. We didn't pierce it, but we're right at it. So any consolidation above that really fails to start, providing us higher highs, starts to turn this into a flush point. And if it breaks, we obviously know the target is going to be the invasion day lows around 410.65. So that's our downside case here in the S&P 500. I would also point out from the 30-minute perspective, if we zoom in on this side, there we go. Let's grab the Fibonacci's. We're going to show you something fairly interesting. If we come from the high down to the low, notice where your 38.2 is. Right here, it's the exact low of the morning 30-minute initial balance. So to me, I'm going to start using that as a pivot and not be so concerned with, it has to remain underneath 417.50. Okay, so we're going to remove those fibs so we can see a little bit more clearly. Here's the low of the morning, right? We get that fake move to the upside, bull trap, if you will, whatever you want to call it, and then it's straight lower throughout the course of the day. Any consolidation that happens underneath that opening range low, 419.25, we'll call it for round number sake, is just putting in a big bear flag. We would expect breakdowns, and again, that would be that consolidation case that I was just discussing that turns this into a flush point, and then we get the break for the 410.65. That's the downside case that I'm seeing right now in the S&P 500. Before you just assume it has to be lower, it wouldn't really make sense if I didn't talk about context, right? If we think about the context of the overall market, clearly we are in a downtrend, but how has this trend been acting, right? It's been acting very, very choppy. It's a very, very tough market to read right now. So I wouldn't be surprised if the market wants to turn around and give us an update tomorrow. We've seen this story before, right? Here, it looks like we're getting bullish consolidation, day down, breakout, right back inside a range, bullish hammer candle, breakdown, right? Rally off the lows, close down weak at the lows. The next morning we gap up, the next morning we gap down, but it's still a day higher. Then we gap up and we're right at the pivot point, and then it's back lower, right? What I'm getting at here is that the market's been incredibly choppy. There's nothing it can kind of do right now that would throw me a curveball and say, oh, wow, I wasn't expecting that, right? Kind of expect anything to happen in these current market conditions is what I'm getting at. So although yes, the charts do point to bearish based on classic technical analysis, be aware that the volatility in market conditions might give us something that looks like that, and you shouldn't be caught off guard. Basically, to mitigate your exposure on a move like that, be patient and be tactful with your entries. If you start to see this consolidation, that's great. Don't just assume it's short. Wait for the breakdown. Get into your position on the break or whatever your strategy would tell you to do, but that's what I would think is more of a confirmation type move, and then place a stop loss immediately, because if this thing whips back higher, it's probably going to the top of the balance, right? And you don't want to be caught on the wrong side of that move. So in market conditions like this, use a stop loss, be prepared to be stopped out multiple times, and don't be surprised by anything that the market does. If that doesn't really suit you as a trader and that doesn't fit your psychological profile, then there's nothing wrong with potentially sitting out and waiting for some more clean trends to develop. Now, it would go without saying as well that obviously at Wednesday, so we'll put W, at 2 p.m. this week, we're of course going to get the FOMC meeting minutes, and we'll also have the Fed funds meeting where we're expecting a 0.25 interest rate increase. So because of that, expect extreme volatility. And again, all it takes is Jerome Powell saying the right words, and the next thing you know, we're at 440 in the SPY. We've broken the resistance trend line, and we're rallying higher. He could also say the right combinations of words that would easily put us underneath 410.65, right? So at this point in time, I'm not going to be surprised by whatever the market does. I'm looking at these levels. I'm thinking about that pivot point that we pointed out here, 419.15, 419.25, and we're going from there. If we get the consolidation and it looks bearish, we get the break. Obviously, it's a bearish play. You're going to look to play the short side with a stop up above, right? If it starts to turn here, then fine. Look for the top end of the range here, 429, with a stop just below. Be prepared for either direction, but do know that the charts are pointing to lower based on what we're seeing so far. So that's my end of the mini rant here in the SPY. Let's continue along along and talk about the QQQ NASDAQ 100, which of course is exhibiting relative weakness here, you can see that we're already at and have even punctured the invasion day lows. So 418.20 is the number to watch. I wouldn't be surprised if we get some sort of dead cat bounce and then a reattempt after a lower high. It could happen on an intraday basis, okay? So I would really be monitoring these lows here. If they break, we know that the first target underneath, if we get this to scrunch up enough, is this little gap and also support from in here. That's roughly 315.80 down to 314.80. It's a dollar wide. You're not trading for that range. It's just going to act as a target. So that's the first downside. And then anything underneath that, we're looking at 309. Okay, so that's your QQQ in a nutshell to the downside. And again, the chart would suggest more bearish than bullish activity with a bear flag being put in into the afternoon. Let's just keep it congruent here with our Fibonacci's from the highs down to the lows. You can see that your 38.2 is even lower than your opening range low, so there's relative weakness, right? Anything that happens underneath 321, we'll call it for round number's sake, is the bear flag situation, and we would look for lower out of that. If we can recapture that, then where's the target? Probably the low end of the 2 days of green there, around 329. Sure, we did get a little bit of a dip down underneath, but you can see how much more well-respected your 329 level is. So resistance here before ultimately breaking, support on that morning opening range. If we scrunch it up a little more, support on that morning opening range. It's the prior lower high from that wacky Tuesday of last week. That's the upside target, right? If we can, crack above here, put in a higher low, maybe it's the rotation into 329. Again, be prepared for some serious volatility that should be happening around 2 p.m. on Wednesday. The QQQs and NASDAQ are not immune from that, so be prepared, right? Anything the market does at this point in time is not going to be surprising. However, do know that the charts here are pointing certainly in the bearish direction, all right? So that's what we've got in the QQQ. Even if you're a bit more of an aggressive trader, you could watch for something like this. So say the move is higher and you don't trust it. You're kind of looking at these charts. You're saying, you know what, I'm more bearish than bullish. Maybe you look for reversal patterns off the 329 for a daily lower high, correct? Something that would look like this. Let me zoom in here. So something that gives us this, and then a reattempt to here. So anything on the 30-minute that might form a double top up there, anything that might form a head and shoulders pattern, right? Break of the neckline, it takes you back lower for the equal low here, the invasion day lows, 318.20. So those are a number of ways to look at your QQQ, but do know the chart does look more bearish than bullish. Let's continue along and talk about IWM Russell 2000 and our small caps. What do we have going on in this name? You can clearly see we're starting to break down, but we're still nowhere near, as opposed to the SPY and the QQQ, those invasion day lows. So 187.75, 188, if you like nice round numbers, that's ultimately the target. However, notice that if we just draw in our consolidation range, you could either draw it like this or like this and call this a fake look above and fail essentially twice. Doesn't really matter how you want to draw it. Regardless, if you draw in the midpoint of the range, which is roughly right in here, we're breaking away from that, okay? We've now closed underneath the 3-day balance here. We've broken these 2-day lows. It is looking more bearish than bullish, obviously an uptick in red volume as well. We're looking for the follow through into the downside here. And if we take a look at our 30-minute intraday time frame with the Fibonacci's as we've been doing, coming in from the 930 low, here we go. We actually had a red candle up to the high. Oops, I don't know why we did that, but regardless, you can see obviously that's cracked, but instead we'll come from that high down to the low of the day. There we go. That's what we wanted. 38.2 is here. There's your bearish flag consolidation underneath 194 essentially is nothing more than that. I would really start to use this level as well, 193.50 coming from the 2-day lows right here on the daily time frame. So anything that happens here, bearish, looking for rollover and continuation off of the breakdown from this consolidation piece right here. So does look bearish as well in the IWM, not really seeing any reason for a reversal pattern back to the upside. If it does want to start putting in higher highs and higher lows on the 30-minute time frame, again, just like in the QQQ, you could be looking for shorts on the back test of the breakdown of the 3-day balance, which is 197 even. So if you see any double tops, same sort of deal, right? Double tops off there, break of the neckline takes you back lower, target this area right here, any sort of head and shoulders, you get the gist, right? Looking for bearish back tests of your 197 for short entries and trend continuation here to the downside on the daily. Something I would also point out that was different about the IWM just by a little bit is the fact that we were talking about compression of range, something that looked like this in the weekly video. Notice what's happened on today's session. Not only did we break the 2-day lows, but we're clearly underneath the support trend line that was semi-intact, right? So that's another bearish indication as well. Of course, Wednesday, 2 o'clock, be prepared. There's going to be volatility there. IWM, again, will not be immune to that. So that's going to wrap up our broad market analysis. If you enjoyed the video today or learned anything new, let me know in the comments section or by giving the video a thumbs up. Don't forget our main channel is linked in the description. And with all of that being said, I wish you a green trading week.